What if China woke up tomorrow and decided to dump every single US Treasury bond it owns? Not trim it, not reduce it slowly, I mean hit the sell button on over $800 billion worth of US debt. Yields spike, markets shake, news alerts explode, your mortgage rate jumps, your 401k drops. Sounds thematic? Maybe, but in 2026, with US-China tensions high and America sitting on over $36 trillion in national debt, this isn't just geopolitical theater. This is your money, your job, your future. So let's break down what would actually happen and what you should be doing about it right now. Let's start with the basics. In 2026, the United States has more than $36 trillion in national debt. That's not a typo, trillion with a T. Now, not all of that is owned by foreign countries. A big portion is owned domestically by the Federal Reserve, pension funds, mutual funds, and banks. But foreign governments still hold a significant chunk. China currently holds roughly $800 to $900 billion in US Treasury securities. That makes it one of the largest foreign holders, though Japan has often been slightly ahead in recent years. Now, here's the key point. $800 billion sounds massive, and it is, but compared to the total US Treasury market, which is over $27 trillion in publicly held debt, it's not the whole system. So what does it actually mean when we say China dumps US debt? It means China sells its Treasury bonds into the open market. When you sell a bond, its price drops, and when bond prices drop, yields or interest rates rise. That's the inverse relationship. Think of it like a house sale in your neighborhood. If one homeowner suddenly slashes their price, it affects the perceived value of every similar house nearby. If China starts aggressively selling treasuries, it sends a signal: we don't want this asset. That signal alone can cause other investors to hesitate. But here's the question you should be asking. Would this actually crash the system, or would the market absorb it? Because the US Treasury market is the deepest, most liquid financial market in the world. On many days, hundreds of billions of dollars worth of treasuries trade hands. So even though $800 billion is huge, it wouldn't necessarily hit all at once. Still, if dumped quickly, yields could spike sharply, and that's where things start affecting you directly. So let's talk about that ripple effect. If China began selling aggressively, treasury prices would fall, yields would rise. In 2026, the 10-year treasury yield has been hovering around the 4 to 5% range, depending on inflation data and Federal Reserve policy. If panic selling pushed that to 6% or higher quickly, we'd feel it almost immediately.
Why? Because the 10-year treasury is the benchmark for everything: mortgage rates, corporate borrowing, auto loans, even credit card rates indirectly. Imagine you're buying a house. Mortgage rates in 2026 have already been sitting around 6 to 7%. If treasury yields spike, mortgage rates could move toward 8% or higher. That dramatically reduces affordability. Housing demand slows, home prices soften, construction slows, jobs and housing-related industries feel pressure. Now think about corporations. If borrowing costs jump, companies with heavy debt loads get squeezed. Profit margins shrink, stock prices fall. The S&P 500 doesn't like sudden rate spikes. Your 401k? It's exposed. And here's another layer. Higher yields mean the US government itself pays more interest. Remember, interest payments on the national debt are already exceeding $1 trillion per year in 2026. If rates climb meaningfully, that interest bill balloons even more. That increases deficits, which means more borrowing, which means potentially more upward pressure on rates. It can become a feedback loop. But before you imagine total collapse, we need to zoom out. Because here's what most people miss. China selling treasuries hurts China too. If they dump bonds aggressively, prices fall. That means they'd be selling at lower prices, locking in losses. It would also strengthen the Chinese yuan if they convert dollars back home, which could hurt their export competitiveness. And China's economy in 2026 is already dealing with property sector stress and slower growth compared to the 2010s boom years. So would China really press the self-destruct button? This is where history becomes important. Let's rewind. In 2011, during the US debt ceiling crisis, markets panicked. Treasury yields moved sharply. The US even had its credit rating downgraded by Standard & Poor's. But did treasuries collapse? No. In fact, investors ran into treasuries because in global finance, they're still considered the safest large asset. In 2020, during the COVID crash, markets froze. The Federal Reserve stepped in aggressively, buying trillions in bonds. Its balance sheet expanded from under $4 trillion pre-COVID to nearly $9 trillion at its peak. Liquidity stabilized the system. And in 2022, when the UK experienced a bond market crisis due to fiscal policy concerns, the Bank of England intervened directly to stabilize yields.
The pattern is clear. When sovereign bond markets face disorderly moves, central banks step in. If China tried to dump treasuries rapidly in 2026, the Federal Reserve could counter by buying bonds. U.S. pension funds, insurance companies, banks, and global investors seeking yield could step in as well. Higher yields actually attract buyers. That's the paradox. Selling pressure pushes yields up, but higher yields make the bonds more attractive. At some point, demand returns. So the real risk isn't instant collapse. The real risk is volatility, sudden spikes in rates, stock market turbulence, short-term fear. And volatility is where unprepared investors get hurt. Which brings us to the part that matters most. So what should you actually do if geopolitical tensions rise and headlines scream that China is selling U.S. debt? First, don't panic sell your investments based on one headline. Markets price in fear fast. Emotional decisions destroy long-term wealth. Second, understand interest rate sensitivity. If you hold long-duration bonds or bond funds, they fall harder when yields rise. Shorter-duration bonds are less sensitive. Know what you own. Third, diversify globally. If your entire portfolio is US-only stocks and bonds, you're concentrated in one system. International equities, emerging markets exposure, and global revenue companies can reduce single-country risk. Fourth, own some real assets. Historically, during periods of rate volatility and geopolitical stress, assets like commodities, energy infrastructure, and sometimes gold provide diversification, not as a bet-the-farm move, but as insurance. Fifth, manage your personal debt wisely. If rates spike, variable rate debt becomes dangerous. Fixed rate debt becomes valuable. If you've locked in a 3% or 4% mortgage, that's powerful in a higher rate world. Sixth, maintain liquidity. In volatile environments, cash flow equals optionality. An emergency fund covering 6 to 12 months of expenses is more important than trying to perfectly time macro events. Here's the bottom line. Even if China sold every treasury bond it owns, the US financial system wouldn't simply implode overnight. The treasury market is too large. The Federal Reserve has too many tools. Global investors still need a deep, liquid asset to park trillions of dollars. But that doesn't mean there wouldn't be pain. Higher volatility, rate spikes, market drawdowns, headlines designed to scare you. The winners in that environment aren't the ones who predict the exact day something happens. They're the ones positioned for resilience. Here's the truth. China dumping US debt would be dramatic. It would shake markets. It would test confidence. But global finance is interconnected. Mutually assured disruption makes extreme moves unlikely. The bigger risk isn't a sudden dump. It's long-term debt accumulation, rising interest costs, and slow erosion of purchasing power. So ask yourself, is your portfolio built for headlines or for resilience? If this breakdown helped you understand the real risks behind the noise, hit like so more people see it. Subscribe for smart, no-hype finance analysis for 2026. And in the comments, tell me, do you think China would ever actually pull that trigger, or is it just political leverage? Because in markets, preparation beats prediction every time.